Hello, and welcome to today's brief presentation entitled Executive Compensation in Tax-Exempt Organizations, Nonprofit Quick Guide to Navigating Intermediate Sanctions. This is part of the cbiz Compensation webcast series. In terms of what we'll cover today, first we want to answer what is intermediate sanctions and why should I care? Secondly, we'll discuss how can I protect my organization and its board. Let's jump right in. (501c3) and C4 organizations must pay fair market value to their executives and board members. Otherwise, they're engaged in what's called an excess benefit transaction. Most importantly, the burden of proof is on the tax-exempt organization to prove under audit that their compensation is at reasonable levels. If this is found not to be the case, there's a two-tiered excise tax for disqualified persons, and organizational managers may be required to pay a tax as well. Typically, these include board members, executives, founding members, and large donors to the organization. The whole idea behind intermediate sanctions is that it provides the IRS with a remedy short of revoking the tax-exempt status of the organization. So why should I care? First, there's a 25% penalty to disqualified persons that can be raised up to 200% if the issue is not corrected. For organizational managers, there's a 10% tax capped at $20,000 per transaction. Now, these penalties are imposed on the amount of the excess benefit, and it's important to note that there is joint and several liability for all penalties. This means that each board member or each executive is individually responsible for the total amount. Finally, the IRS does reserve the right to remove the tax-exempt status of the organization in extreme situations. There are a number of trends that we're seeing at cbiz as it relates to executive compensation in nonprofit organizations. Specifically, the IRS is adding tremendous amounts of field agents with the idea of pursuing excessive compensation in nonprofit organizations. Some state attorneys general, specifically in California and New York, are beginning to review compensation. In fact, they require that nonprofit organizations review executive compensation on an annual basis. Finally, there are proposals in Congress with the attempt to both clarify the rules regarding reasonable compensation, but also with the goal of clamping down on executive compensation. In addition to these compliance issues, any violation, even if it's inadvertent, can mean tremendous embarrassment and could directly or indirectly impact an organization's ability to raise money. Finally, the IRS has made changes to the Form 990 that make it easier for them to identify organizations that have exposure for excessive compensation. In terms of the changes to the new 990, the rest of this presentation will outline a process whereby you can shift the burden of proof from your organization to the IRS. The new questions asked in the 990 specifically ask if you have shifted that burden of proof. In our informal discussions with the IRS, it's our understanding that the answers to these questions will be used as filters when determining which organizations to audit. You should consult a tax advisor on the proper completion of the Form 990. So what is that process? How can I protect the organization and its board? The process for protecting your organization is called the rebuttable presumption. Essentially, by following this process, compensation levels in your organization will be presumed to be reasonable. There are three requirements to establishing the rebuttable presumption. First, compensation arrangements must be approved in advance by an independent party. Typically, this is already occurring in most organizations because boards are making executive compensation decisions. Secondly, they must rely on appropriate data when making those decisions. This is typically where a compensation consulting firm, such as cbiz, will become involved. The third step is that they must document those decisions both adequately and concurrently. Typically, this is occurring in the form of board minutes. So how should reasonable compensation be determined? The IRS has provided guidance that compensation should be based on the nature and duties, the size of the organization, economic conditions, both generally and locally, the amount paid to similarly situated individuals in similar organizations. Notice that those are all components or descriptors of a job. The last two, including time devoted to the job and background and experience, all speak to the individual incumbent. What types of data should be considered? Compensation can be compared to both tax-exempt as well as taxable organizations, and all forms of compensation should be considered. In addition to base salary, certainly considerations for bonus, perquisites, as well as long-term incentives can be included in the analysis. Most typically, these data come from current compensation surveys. As a firm, we spend upwards of $80,000 a year on compensation survey data. However, additional forms of data that are specifically mentioned in the regulations include written offers to your executives. There's also an initial contract exclusion that essentially says when the contract is negotiated at arm's length, the initial contract is by definition reasonable. However, it's important to note that any modification to the contract, including something as simple as a 3% salary increase, does eliminate the initial contract exclusion. Here's what appropriate data might look like. You can see that for the President and CEO, we're comparing actual compensation at all different levels: base salary, total cash compensation, perquisites, benefits and retirement, as well as long-term incentives, to determine the actual total compensation. From there, we're providing comparability data at the 25th, 50th, and 75th percentiles of the market, of for-profit, not-for-profit, as well as aggregated all-organization data. In summary, it's important that you protect your organization and board by following the rebuttable presumption. To do so, the board should approve in advance any compensation arrangements. They should rely on appropriate data to do so, and they should document adequately and concurrently why compensation decisions are being made. Finally, all compensation should be disclosed on the Form 990, otherwise you may trigger an automatic excess benefit. I hope you found today's presentation informative. To see more compensation webcasts, please visit us at www.cbiz.com/hr/compcasts. Or for specific questions, please call me directly at 314-692-5884. Thank you very much.